Global enterprises are right now, as we speak, bleeding millions of dollars in taxes for carbon emissions that, well, literally do not exist.
Yeah, it's a massive financial black hole just hiding right in plain sight.
Right. Welcome to today's deep dive for Wednesday, June 17th, 2026. We are exploring a totally different kind of corporate leak today, and honestly, it is custom tailored for you.
Whether you're, managing a complex global supply chain or you just want a shortcut to understanding one of the most absurd math errors happening in modern business right now.
Exactly. Our mission today is to figure out how these massive companies ended up trapped in this data gathering nightmare, and how the actual solution isn't some wildly complex artificial intelligence, but a remarkably simple, almost stubbornly low-tech approach.
Which is so refreshing, honestly. I mean, the stakes here are incredibly high. New regulatory mandates like the EU's Corporate Sustainability Reporting Directive are forcing a spotlight onto a very dark corner of corporate accounting.
Yeah, and to get us through this, we are pulling from a really fascinating stack of sources. We've got an uncompromising editorial piece by tech operator Prasad Bond on what he calls phantom carbon.
Plus, a comprehensive strategic framework from McKinsey & Company on the materials value chain, and an operational breakdown from the carbon intelligence platform, Climatic.
Okay, let's unpack this. We need to define the playing field first so you, the listener, understand the exact nature of the problem before we get into the flawed ways companies try to solve it.
Right, so we all know the drill with Scope 1 and Scope 2 emissions.
Yeah, that's just your direct exhaust from company vehicles and the purchased electricity for your own building.
Exactly, the easy parts. You just read your own utility meters. But Scope 3, that represents all the indirect emissions that occur up and down a company's entire value chain.
Which is the incredibly hard part.
Oh, it's a nightmare. For most manufacturing enterprises, Scope 3 accounts for something like 70 to 90% of their total carbon footprint.
So it's basically the whole ballgame. And Bond brings up a figure he calls the choke point owner.
Right, the Chief Sustainability Officer for CSO. They hold all the compliance liability for Scope 3. If the EU gets bad numbers, the CSO is the one in the hot seat.
But here's the catch. They crucially lack the operational authority over their own procurement teams to actually force suppliers to hand over the data.
Yeah, it's a structural nightmare. The CSO desperately needs granular energy data from, let's say, a mid-market Tier-2 supplier, like a small steel foundry in Ohio or something.
But the procurement team, their entire bonus structure is built on keeping that specific foundry happy and producing materials cheaply.
Exactly. They have zero interest in antagonizing them. They don't want to bombard a critical vendor with endless spreadsheets and, 50-page environmental surveys.
Trying to track Scope 3 emissions is like trying to calculate your exact household energy footprint, but being forced to somehow include the electricity used by the factory that manufactured your toaster.
That is a perfect analogy. You have no jurisdiction to demand that info, and they have no incentive to give it to you.
And Bond points out that these mid-market Tier-2 suppliers are just exhausted. He calls it the vendor bottleneck.
No, yes, supplier fatigue is very real. They view these requests from Fortune 500 companies as completely unpaid administrative labor.
And even if a supplier wanted to help out, you hit an immediate physical barrier, right?
You do. An enterprise's legacy ERP system, their enterprise resource planning software, is usually a totally locked-down walled garden.
So the IT departments are actively blocking integration to prevent cyber attacks.
Exactly. The suppliers are running 10-year-old on-premise servers,
Yeah.
IT won't allow external API access, and the data is just fundamentally trapped.
So the CSO has a strict regulatory mandate, zero direct data, and IT systems that block integration. So what do?
Well, they find a workaround. And Climatic's operational breakdown highlights the financial shortcut the entire industry uses. It's called spend-based accounting.
Spend-based accounting. Okay, so because they lack actual physical activity data, they just look at their financial ledgers.
Right. Procurement tracks every penny. So if you spent $10 million on steel, you take that dollar amount and multiply it by a generic emissions factor.
Using models like Axiobase, right? But how does a model translate a dollar amount into a carbon molecule?
So Axiobase maps the global economy into sectors. It looks at the steel sector in a specific region, calculates the total energy used, and divides it by the total economic output.
Okay, so it basically says, on average, $1 million of steel here equals X tons of carbon.
You got it.
Yeah.
But the flaw there is massive. It completely ignores operational reality.
Because if I buy from a supplier who just upgraded to super efficient electric arc furnaces running on solar power, the spend-based model doesn't even know.
Doesn't care at all. It just blindly attaches a generic, dirty regional average to the invoice amount.
Which leads us to Prasad Banda's concept. He calls this exact phenomenon phantom carbon.
Phantom carbon, yes. Because spend-based accounting relies on these broad averages, it routinely overestimates actual emissions by up to 40%.
Wait, 40%?
Up to 40%, yeah. They are effectively creating carbon on paper that does not exist in the physical atmosphere.
Wait, I have to push back on this. If a publicly traded company knows this method has a 40% margin of error and they're going to pay real regulatory taxes on it, why on earth do they accept it? Is it really just laziness?
What's fascinating here is it's actually not laziness. It's a perceived lack of alternatives.
They think this is the only way.
Yeah, they assume capturing actual primary data from thousands of suppliers requires a multi-million-dollar infrastructure overhaul.
Like forcing every small foundry to install expensive IoT sensors.
Exactly. Or buying complex enterprise ESG software. They assume a deep regulatory problem requires deep tech, like massive algorithmic intervention.
Bond mentions that bootstrap tech teams will waste months building complex predictive AI software for this.
And it's completely unnecessary, because carbon emissions map directly to physical reality. Burnt fuel.
And the data for burnt fuel originates somewhere very specific.
The utility meter. The exact physical utility meter.
Here's where it gets really interesting. Bond introduces the actual frictionless solution, the zero-friction Scope 3 data bridge.
It's brilliant. A startup simply asks the mid-market foundry for a standard PDF of their monthly utility bill.
Something they already process for their own accounting anyway.
Exactly. Then the startup applies basic optical character recognition OCR to read the raw kilowatt hours right off the bill.
It's like spending millions to invent a smart scale to weigh your groceries when you could literally just read the weight printed on the receipt.
That's exactly what it is. The OCR converts the raw fuel usage into audit-grade, activity-based primary carbon data.
And then they just pipe it directly into the enterprise ERP via an API?
Yep. The startup charges a recurring verified data node fee. The enterprise saves millions in phantom carbon taxes.
And the supplier changes absolutely nothing about their operations. Zero friction.
Everyone wins. The enterprise pays for the data, gets the tax savings, and the supplier is left completely alone to do their job.
Okay, so the OCR bridge gives companies accurate data. The blackout is over. But what do they actually do with it? I mean, counting carbon doesn't actively reduce it.
Right, and that's where we transition to the McKinsey framework. Now that you have real data, you start playing offense.
Okay, so McKinsey outlines these specific strategic levers leading companies are using to transform their business models. Let's talk about the upstream strategies first.
Sure. Look at Volvo Trucks. They're actually designing vehicles with fossil-free steel in direct collaboration with their suppliers.
And McKinsey also mentions BHP working with the steel manufacturer HBIS.
Yeah, that's a huge one. They're optimizing iron ore for a lower emission process called direct reduced iron, or DRI.
Wait, how does DRI work compared to normal steelmaking?
Well, traditional steel needs a blast furnace with coking coal, which releases massive amounts of CO2. But the DRI process uses syngas, or pure hydrogen, to strip the oxygen from the iron ore.
Oh, wow. So if you use green hydrogen, what's the byproduct?
Water vapor. The byproduct is literally just water vapor.
That's wild. And they're doing similar stuff downstream too, right? Like partnerships?
Definitely. Vale and Boston Metal are partnering on molten oxide electrolysis technology, using electrons to separate oxygen instead of burning coal.
And there's a circularity partnership between Ørsted and Salzgitter, using recycled wind turbine scrap in steel production.
Plus entirely green portfolio shifts. Schneider Electric is pivoting completely from hardware to energy management, and Nest is shifting from oil to biofuels.
Okay, so we're looking at everything from changing the literal chemical recipe of the materials to totally changing the company's entire business model. How does a company even begin to orchestrate all of this?
If we connect this to the bigger picture, McKinsey says you have to establish a clear North Star focused on value creation.
Like capturing green premiums from customers who are willing to pay more for clean products.
Exactly. It's not just risk management anymore. And to orchestrate it, companies are setting up cross-functional capability academies to upskill the entire organization. You have to wire it into the company's DNA.
But practically speaking, grounding this back into the day-to-day reality of the listener, you can't perfectly track every single paperclip you buy.
No, of course not.
So how do you actually implement these accounting and reduction strategies without collapsing under the complexity?
Well, that's where Climatic's recommendation comes in, the hybrid approach.
Okay, so spend-based methods aren't entirely useless then.
Not at all. They're actually highly effective for a first high-level screening. If you have a massive supply chain, spend-based accounting is a great way to identify hotspots.
And for high-volume, low-impact categories, right, like Scope 3.1 purchase goods, office supplies.
Right. You don't need utility bills for the company that makes your sticky notes.
Whether you are managing a global supply chain or just prepping for your next department meeting, this is really about knowing when to use a blunt instrument to get the lay of the land and when to use a scalpel.
Exactly. Carbon accounting is iterative. You start with the financial data you have, you identify those massive 40% errors in your highest cost areas.
And then you deploy the activity-based method, like the OCR utility bill bridge, to get precise data for the high-impact stuff.
Yes. Systematically replacing your assumptions with primary, physical data where precision actually saves you money.
This has been such a journey today. We've unpacked the absolute nightmare of Scope 3 reporting and that costly trap of phantom carbon caused by spend-based accounting.
Which is just wild to think about.
Right. And then the surprisingly low-tech OCR solution to bridge that data gap and the strategic levers companies can pull to turn this massive compliance headache into a competitive advantage.
It really is a total paradigm shift.
So what does this all mean for you? It means obscurity costs millions, but primary data restores your balance sheet.
And it leaves us with a really fascinating question to ponder. If entire global regulatory systems and massive enterprise budgets are currently being driven by lazy math and phantom estimates, what other massive systemic metrics in our society or your own industry are just waiting to be disrupted by something as simple as reading the primary data?
That is exactly the right question to ask. Keep asking those questions, and we will catch you on the next deep dive.